Hello and welcome to Follow the Money. I'm Raine Musñgi. Join us as we explore the tools and insights you need to jumpstart your financial journey. Another day, another round of U.S. restrictions. The United States takes a new step against China's semiconductor industry, imposing export restrictions on 140 companies. This is the third major crackdown in 3 years. According to the U.S., these companies, including some investment firms, are supporting China's development of advanced chips that could threaten American national security. The new rules restrict their access to critical U.S. technology and equipment, including high-bandwidth memory chips that are essential for artificial intelligence training. Meanwhile, China criticizes the move, claiming it disrupts global trade and supply chains. Beijing has vowed to take measures to protect its businesses. China's factory activity surges to its fastest pace in 5 months, providing a boost to the world's second-largest economy. The Manufacturing Purchasing Managers Index, or PMI, increased to 52 in November, up from 50.3 in October, clearly surpassing the 50 mark that separates growth from contraction. The expansion was driven by a rise in new orders, indicating stronger demand. Analysts attribute this growth to renewed confidence in China's economic recovery, supported by pro-growth government policies. Meanwhile, China has opened a total of 156 international air cargo routes this year, with an additional of more than 430 round-trip flights each week. The distribution of these routes highlights a strong focus on Asia, which accounts for 78 routes, followed by Europe with 50 and North America with 23 routes. The primary cargo types being transported include cross-border e-commerce goods, fresh produce, electronic products, and automotive parts. Several major airports have reported record monthly cargo flight volumes in November. Shanghai Pudong, Shenzhen Bao'an, Guangzhou Baiyun, Ezhou Huahu, and Zhengzhou Xinsheng airports have all achieved either annual or historical highs. Meanwhile, in a surprise move, Intel outs its CEO Pat Gelsinger, capping a tumultuous 4-year tenure at the semiconductor company. This comes after a contentious board meeting last week over Gelsinger's perceived failure to respond to NVIDIA's competitive edge. Intel was previously America's leading semiconductor company, but in August, it reported disappointing quarterly results, sparking the sharpest sell-off in 50 years. Its stock price has fallen 52% year-to-date. Still on corporate shakeups, Stellantis, the European automaker behind brands like Jeep, Peugeot, and Maserati, sees its shares plunge to a 2-year low after the sudden resignation of its CEO Carlos Tavares. Based in the Netherlands, Stellantis is the world's 4th largest car maker, formed through the merger of Fiat Chrysler from the US and PSA Group from France. An official says Tavares stepped down due to recent disagreements with major shareholders and the board. A replacement is expected by the first half of 2025. Tavares, once regarded as one of the auto industry's most respected leaders, has recently faced pressure following falling sales in North America. This led to a profit warning in September and a forecast cash loss of about 10 billion euros or $10.6 billion for this year. Stellantis' troubles have global implications. As a major player in the auto industry, its leadership turmoil and financial struggles could impact supply chains, delay vehicle launches, and intensify competition among global car makers. Continuing with our thread in the auto business, in Europe, workers at 9 Volkswagen plants in Germany go on strike as labor and management remain in dispute over the future of the company's operations in the country. Thousands of employees gathered Monday at Volkswagen's headquarters in Wolfsburg, with protests also taking place at several other plants. Volkswagen says it respects the workers' right to strike and has taken steps to minimize the impact. However, the company is pushing for a 10% wage cut to lower costs. They've even threatened to close plants in Germany, a move that would be a first in its 87-year history. If no agreement is reached, the strikes could escalate, further straining VW's production during a challenging period of declining deliveries and plunging profits.
Wir sind total streikbereit.
The negotiations will continue in a week's time, on December 9th. Let's see how the employer's side presents itself. I am pretty sure that this round of negotiations on December 9th will set the course, rapprochement or escalation. We are prepared for both.
For global business, the strikes highlights the risk of disruptions in the auto supply chain, potentially impacting car parts availability and vehicle prices worldwide. Countries like the Philippines could feel a ripple effect if the global automotive market slows or if imported vehicles become more expensive. Back in the U.S., General Motors will sell its stake in its joint venture battery plant in Lansing, Michigan, to partner LG Energy Solution as the Detroit automaker trims its electric vehicle plans. GM expects to recoup its investment in the facility, said to be about $1 billion. The deal, which is expected to close early next year, does not change its ownership stake in the Ultium Cells joint venture, which operates battery plants in Ohio and Tennessee. The announcement comes amid uncertainty about the future of key EV battery production and consumer tax credits. Now, as Reuters reported this month, President-elect Donald Trump's transition wants to kill the $7,500 consumer tax credit for electric vehicle purchase. Tesla CEO Elon Musk lost his bid to get his $56 billion CEO pay package reinstated on Monday when a Delaware judge upheld her prior ruling that the compensation plan was improperly granted. The 2018 package was the largest compensation plan in U.S. history for a public company executive. In January, Chancellor Kathleen McCormick voided the pay plan, ruling that Musk had individually controlled Tesla and dictated the terms of its compensation to a board that didn't fairly negotiate. Tesla said in a post on X that it plans to appeal the ruling, which Musk in a separate post on his social media site called absolute corruption. In the next 2 minutes, we'll bring you the latest from the Fed and news on the Philippine economy. Stay on BNC and follow the money. Welcome back to Follow the Money. The Department of Trade and Industry says the Philippines is unlikely to be affected by potential tariff hikes under the incoming Trump administration. DTI Undersecretary Seferino Rodolfo points to the balanced and healthy trade relationship between the Philippines and the U.S. He explains that countries with significant trade deficits with the U.S. are more likely to be targeted for additional tariffs. Rodolfo also shared that the DTI, alongside Secretary Frederick Go, Special Assistant to the President for Investment and Economic Affairs, is actively engaging with Washington to strengthen economic ties and prepare for the changes under a Trump presidency. The government slashes its economic growth target for 2024, but broadens the target range for the coming years, pointing to a shifting domestic and global challenges. Sujin Kim has the details.
The Development Budget Coordination Committee, or DBCC, on Monday revised the government's medium-term macroeconomic assumptions. The DBCC narrowed its growth target for the year. Finance Secretary Ralph Recto says he doesn't expect the economy can grow by 7% this year.
Because of so much uncertainty, we thought it best to widen the band from a low of 6 to a high of 8.
Targets for the next years were likewise adjusted.
The growth assumptions for 2025 to 2028 have been given a wider band of 6 to 8%, reflecting the anticipated impact of structural reforms and evolving domestic and global uncertainties.
The peso is expected to remain stable at an average 57 level against the US dollar for 2024.
This is not unique to our currency, and it's actually a story of a strong US dollar. Now, there's still a chance that the peso can strengthen, especially because of seasonal factors during the Christmas holiday. And we are also expecting that there will be support for the peso in line with the fundamentals, including sustained growth of remittances.
It is expected to broadly stabilize at 56 to 58 peso against the US dollar for 2025 and 55 to 58 pesos against the USD for 2026 to 2028.
BSP Deputy Governor Francisco Daquila Jr. says the BSP is expecting remittances to grow by 3% annually, reflecting their expectation that over the medium term, the peso will continue to be broadly stable. The DOF is still refining their tax proposals but reaffirms that none are consumption-based. Part of their fiscal consolidation strategies include accelerating revenue efforts.
The BIR and BOC is expected to grow double digit. By next year, they'll be collecting at least an additional 1 billion additional a day. And then the following year, another 1 billion additional a day.
This will be supported by recalibrated legislative measures that will provide a significant revenue boost to the government, such as the recently enacted VAT on Digital Services Act, and by tax administration reforms centered on digitalization.
The chief economic manager maintains it is best to stick with gradual fiscal consolidation in spite of credit rating agencies saying rapid fiscal consolidation can trigger an upgrade.
That's why it's positive. Right? So for as long as we follow that downward trajectory in the deficit, I think maybe in 2 years' time, or 18 months to 2 years, you could get a credit rating upgrade.
Sujin Kim, BNC.
The ASEAN Plus 3 Macroeconomic Research Office, or AMRO, lowers its growth forecast for the Philippines this year. AMRO now expects the economy to grow by 5.8% in 2024, down from its earlier estimate of 6.1%. While this means the economy is still expanding, it is doing so at a slower pace than initially projected. The downgrade is attributed to weaker spending and investments. This growth is still an improvement from the 5.5% recorded last year. Now, looking ahead, AMRO projects growth to pick up to 6.3% next year. Inflation, on the other hand, is expected to ease to 3.2% this year and next, a significant drop from the 6% recorded in 2023. AMRO, however, warns of potential risks, including renewed price increases from supply-side issues and a slowdown in the growth of the Philippines' major trading partners. The Philippine Economic Zone Authority, or PEZA, hits its full-year target of 200 billion pesos in investment approvals ahead of schedule. From January to November, investment pledges surged to over 201 billion, up 43.1% compared to the 141 billion pesos approved during the same period last year. These commitments came from nearly 240 new and expansion projects, expected to create over 70,000 direct jobs. For November alone, PEZA approved 41 projects worth 78 billion pesos, marking a massive 752% increase year on year. This achievement highlights growing investor confidence in the Philippines and the potential for economic growth through job creation and industrial development. Back in the U.S., officials of the Federal Reserve say they are considering more rate cuts. Federal Reserve Bank of New York President John Williams said on Monday the U.S. Central Bank is likely to lower its interest rate target further over time as inflation pressures continue to cool. Williams offered no firm guidance about the timing of rate cuts and whether he believes the Fed will lower its interest rate target, now set at between 4.5 and 4.75% at the Federal Open Market Committee meeting this month. For his part, Federal Reserve Governor Christopher Waller said he was inclined toward a cut in the benchmark interest rate at the central bank's meeting, December 17 to 18, as policy remained restrictive enough to keep putting downward pressure on inflation while the labor market was roughly in balance, something the Fed wants to maintain. The comments led investors to boost expectations for a rate cut in December to more than 75% now and push down yields on the 2-year Treasury note. Nasdaq and S&P 500 ended higher, boosted by tech-related shares after the market posted a strong November, with investors awaiting this week's economic data, including the monthly jobs report on Friday. But it's Trump's potential plans for tax cuts and deregulation that are seen as likely to lift the market, while tariffs would be negative.
We have a 7,000 target on the S&P, assuming the corporate tax rate goes to 18%. And most investors don't appreciate the direct impact on earnings and the growth rate of both earnings and the economy. So that's the real upside. And that's why we think the market will continue to grind higher, particularly next year as we get more visibility on how big that corporate tax reduction is going to be.
Meanwhile, Infrastructure Capital Advisors predicts a surge in mergers and acquisitions in 2025 as President-elect Trump potentially loosens antitrust policies, with investment banks set to benefit from the shift. A new lawsuit accuses tech giant Apple of illegally monitoring its workers' personal devices and iCloud accounts, while also barring them from discussing their pay and working conditions. The complaint, filed in California State Court Sunday by Amar Bhakta, who works in digital advertising for Apple, claims the company requires employees to install software on personal devices that they use for work, allowing Apple to access their email, photo libraries, health and smart home data, and other personal information. At the same time, the lawsuit alleges that Apple imposes confidentiality policies that prohibit employees from discussing working conditions, including with the media, and engaging in legally protected whistleblowing. Bhakta, who has worked for Apple since 2020, says he was barred from talking about his work on podcasts and instructed to remove information about his working conditions from his LinkedIn profile. Apple, in a statement provided by a spokesperson, said the claims in the lawsuit lack merit and that its workers are trained annually on their rights to discuss their working conditions. Apple is also facing at least 3 complaints from a U.S. labor board, claiming it has illegally deterred employees from discussing issues such as sex bias and pay discrimination with each other and the media, including restricting their use of social media and workplace messaging app Slack. The company has denied wrongdoing. Finally, U.S. retailers are offering huge discounts to entice consumers to spend on Cyber Monday. This after shoppers made lackluster spending during Black Friday. Ads and emails promoting heavily discounted gadgets, toys, clothing, and other products have been trying to convince cautious U.S. shoppers with just 22 days to go before Christmas. Online spending on Cyber Monday in the U.S. is expected to generate $13.2 billion, that's 6% higher than the previous year. Big retailers like Walmart and Amazon are also using AI customer service and search features to make it easier for shoppers to find products. And that is it for today's edition of Follow the Money. I'm Raine Musñgi. Thank you so much for watching. Keep it here on BNC, the Bilyonaryo News channel, always on top.